So they're looking at that time period. And the reality is, yes, you're going to pass away at some point in time. And those policies are made to pay out when that happens.
Hey, sweet mama. Welcome back to another episode of Mama Mindset. I'm your host and creator, Amy Cawthron. If this is your first time joining me, welcome. You are in for a absolutely dynamite interview today. If you've joined me in the past, welcome back. Thank you so much for supporting this community. You have probably listened to my other interview episodes before, and I work really, really hard to bring you quality guests so we can learn, so we can grow. And this one is truly, truly an interview for growth within our lives, for protecting ourselves, taking steps forward, and taking action steps to plan ahead. Today's interview guest is Andrew Nicholas. He is actually our personal financial advisor, and I've been waiting for a while to have this interview conversation with him. And the timing was right. As a lot of you know, we've recently lost a close friend, and he left behind his wife and his daughter, and then also a 6-month-old baby girl that they have together. And one of the things that I had thought about in this mourning process and thinking about his wife is I was hoping that he had life insurance. She is a stay-at-home mom. She recently left her career to stay home with their daughter. And, me being with my forward thinking and the planner is I hope that she's still able to do that. I hope that she is still able to have that time with her. And one of the ways that we do that is through life insurance. So this is a conversation that I wanted to have prior even to us losing a close friend, but it really came up even more so. It's really been in the forefront of my mind and making sure that we're set up and we're okay. So Andrew decided to come on. He accepted my request to come on the show and share with us his knowledge and his experience in advising other families. He's absolutely incredible. We trust him so much. One of the beautiful things that I love about him is he's 100% on the same page with us, and he understands our goals and our values as a family. We've had numerous financial advisors in the past, and this is not a sales pitch for Andrew. This is me trying to help you as moms know and understand your value, your worth, and to set you up and prepare you in case something happens to you or your husband or both of you. So we dive into some questions on here, different types of insurance, a few different scenarios, and I want you to grab a piece of paper and a pen. You're going to want to take some notes on this. You're probably going to want to take some action steps on some of the things that he suggests and some of the things that we talk about. Again, I just want to let you know that Brad and I do share some specific details about our life insurance and about our household. However, this is specific to us. And the reason why we did this is to just give some specific examples and paint a little bit of a financial picture so that Andrew could have some examples to go off of, because he cannot advise via this interview, but I wanted to have some numbers to paint a picture for you. So it helps you to better understand the scenarios and the steps that we took and the different processes and options there are for you out there. So grab a cozy beverage, grab a pen, grab a piece of paper, and join me and Brad and I in this conversational journey with Andrew. Hey, Andrew, welcome to the show. Thanks for coming on today.
Thanks for having me, Amy.
Yeah, no problem. I'm super excited to have you on. This is a conversation I've been wanting to have for a while. And if everybody is watching this on YouTube, I'll just do a little intro of who's all here, because I have more guests than normal. I have Brad, my husband, joining me today. And then Andrew is actually our personal financial advisor. And We've been with you, oh gosh, we've been with you for 4 years now, I think, 3 or 4 years.
4, I believe.
Something,
Yeah.
yeah. And this conversation I've been really wanting to have. So, what we're going to dive into today is life insurance. And that's probably a very maybe strange topic for stay-at-home moms to really even think about, but I think it's super important. So, before we start diving into that conversation and unwrapping that a little bit, Andrew, will you take a couple minutes and introduce yourself to the audience?
Yeah, absolutely. So my name is Andrew Nicholas. I've been a financial advisor for the last 7 years. I am a husband and father of 3 beautiful children. My oldest, Audrey, is 9, and then Alex is 6, and Arthur is going on 2 at this point. And yeah, got into financial advising 7 years because I realized how little information most people had around the topic of their finances and how little people like to talk about it. And so just not enough information, and not enough information leads to bad decisions. So yeah, that's what got me into it, and been loving it ever since. So
I love that. And your wife is a full-time mom also.
yeah, absolutely. Yeah. So Lydia has stayed at home with the kids since we started having kids.
Mhm.
And it was just super important to us that the kids had somebody at home. And it's just such a super formative time in their lives, especially when they're young. And
Mhm.
so that was something that was just really close to our hearts, and been very thankful that we've been able to do that.
Mhm. So, did you guys decide to do that before you had kids? Was that in the plan before you had children, or how did that look for you guys?
Yeah, we talked about it, and we talked about it, and both agreed that if we were able to, we would like to do that,
Mhm.
and very grateful that we were able to,
Yeah.
and so yeah, it was a conversation we had, and we were very intentional, I guess you would say, about that, making that decision.
Mhm. Ours was a little bit different. We hadn't even really talked about it. Well, I was super career driven. And then once we had Gracie, it was like that came to a halt. Screech,
Yeah.
wait a second. Maybe this isn't quite as important
Yeah.
as we thought it was.
Yeah. Oh yeah. Yeah. Well, it's a big decision. I mean,
Yeah.
to take your career and say, well, I'm gonna put that on hold. That's a big life change.
Mhm.
But I mean, when you realize that in many ways that's your legacy and your future, and you want to, I mean, at least for us, we wanted to be a big influence on their lives and how they were raised and
Mhm.
what was important to them and their values, and making sure, that we were able to do, dinners as a family, or, it just, yeah, all the things.
Yeah.
Um, and so, yeah.
Yeah. I love that a lot. I mean, we're completely on the same page. And it was, since we're talking finances and everything in this conversation, it was really tough for us to go because we hadn't planned on that path. It was
Yeah.
really tough for us to go from 2 incomes to 1 income.
Oh, yeah.
So like you had mentioned being very intentional about it. And that's how we ended up having to shift gears and be very intentional about our plan for me to transition out of my career. And it took a lot of work. It was, I mean, Brad took, I think we've told you this story, but it's been several years, I think, since we talked to you about it. But he had to take on a second job to pay off some of our bills. And we dove into Dave Ramsey and started, the snowball. But the first step that we took was writing down our bills and our finances and where our paychecks were going. And it was something that I had been putting off and putting off and putting off. And I was like, we're fine. We're fine. We don't need to do this. We pay our bills. Like, we're okay. And I was refusing to read the book didn't want to dive into it. And Brad was like, no, you need to do this. We really need to do this. You were very supportive in giving me space and time. And then we dove into it, wrote it down, and I freaking bawled my eyes out because we
Isn't it
were
eye-opening
idiots.
though? Like the first time you write out all the bills and you look back at, where did your money go over the last month? And you're like, I spent that much on coffee?
Yeah.
What?
I-
Or, whatever it is. But
Yeah.
it's crazy. Like
Yeah,
you
it was
don't-
so emotional for me. I didn't expect it to be because in my mind, I was like, we're fine. And then we wrote it out. And with 2 incomes, we were actually still going backwards. And I bawled. You have 2 educated adults, right? College educated, business degree adults that were freaking idiots with our money. Like dumb, young and
Happens to
dumb
all of
and
us.
careless. And I mean, even now I look back and we knew once we wrote that all out, we were like, what have we been doing? But now we look back and we're even more so like, oh my gosh, we were dumb.
Yeah.
So what
I
did
don't
you
know
think
how
when
many
we
times-
done that?
I knew that was going to be a tough conversation,
Mm,
and it was.
yeah.
But the biggest change was I was fully on with Dave Ramsey, and you
Mhm.
didn't want to do it at all. But when you finally read the book,
Mhm.
things clicked, and we sat down and did that, and then everything changed
Yeah.
overnight. It
Yeah.
was like, okay, we got to go, and we got to go now.
Mhm.
Yeah.
So fast forward a couple of years, several years after we did that and we worked through our snowball and we got to, a good place. I'd been home for a while and we were living on 1 income and everything. Brad ended up finding you. So do you want to talk about how you found Andrew and why we chose Andrew?
Yeah. So I was listening and reading a lot of Dave Ramsey, and he kept talking about Smart Vestor Pros. And I didn't know what that was, but apparently it was financial advisors that aligned with his teachings. And so I went onto his website and searched for advisors in our area, and your name popped up, and that's how we got connected. So I reached out, and we set up a meeting and started chatting. So that's how we got together.
Mhm. So you went on to Dave Ramsey's website, just to clarify.
Mhm.
And so Dave Ramsey has a search option on there to find financial advisors that are certified and just in your area. So he makes
Yeah.
it super easy.
Okay, I have to put a little caveat in there because so many people don't know this when they do that. And just like you did, Brad, when you put in your and Amy's information and when you go on the website, there's a spot, it says like find Smart Vestor Pros in your area and you put in your information. Most people don't know that there's a little box at the bottom that if they don't click it or unclick it, their information gets sent to the financial advisors who are Ramsey Smart Vestor Pro financial advisors in the area. And so every once in a while people go, wow, you're calling me? Like, how'd you get my information? Or
Mhm.
they don't realize that it gives it out. So I'm going to let all your listeners in on that so they won't be surprised. If you don't want someone calling you, make sure and click that box if you do it. So.
Click the box. Thank you. So we ended up Brad found you, had you come down. And by this point, I was fully on board. I guess I should add, like, obviously my hesitations went on a total emotional roller coaster, denial, depression, anger, and frustration. And then like fully all in, like, we have to make a change 110%. We like dove in and then we were able to team up and, really get a lot of things accomplished. And so I'm really proud of us. But then he ended up finding you and we met with you and we absolutely loved our conversation with you. And you came down and met us. And so let me back up a little bit. We already had life insurance because that's what I really kind of want to focus this conversation on today. But I did want to give some background on how we got to that point and then how we met you. But we already had a little bit of life insurance, but that was something that we wanted to talk about. And if I remember right, and correct me if I'm wrong, Brad, but I believe we were actually considering stepping away from my life insurance plan because we were still on our debt snowball payoff. And so I think we were talking about stepping away from my life insurance as a way to maybe save a little bit of money each month, because we were trying to figure out ways that we could skim that off, that's how I remember it in my mind. And then Andrew talked to us and was like, actually, her life insurance is
Maybe
very,
not.
very important. What was that?
Maybe not. Maybe we hold off on that.
Yeah. Is that
I remember that.
Is that how that went?
I think so.
Okay.
Yeah, I think so. Yeah.
So let's talk about that, because you absolutely opened both of our eyes, and we have this conversation with people a lot just on the importance of life insurance. Was important to us in general. But we dove into the conversation with you of how it kind of flipped our mindset a little bit. In my life insurance in some ways was actually more important than Brad's. And I'm going to take a pause here. Sorry. And I'm actually going to go back, because as soon as we bought the house, our first home in Lewiston, Brad made more money than I did. And before we even had children, I'm kind of a planner. I like to plan ahead. And I just knew if something were to happen to Brad, if something were to happen to you, I couldn't afford the house payment by myself. And I didn't want to lose the house or have to sell the house if something were to happen to him and he were to be gone.
Yep.
We just kind of wanted that security. So before we even had the children was when we originally got our life insurance. So anyway, so I wanted to take a step back on that a little bit. So stepping forward now, you kind of shifted our mindset in, don't stop Amy's life insurance, even though she's, not working. Can you explain that a little bit, kind of in your own words and what you talked to us about?
Yeah. So it's kind of funny. Life insurance oftentimes is one of those conversations and one of those topics that really isn't very fun to think about. It's like, what if the worst possible thing were to happen in your life? Yeah, nobody really wants to think about that or talk about that. But the reality is, sadly, it happens. And so, as with any insurance, when there's the result, if it happens, is catastrophic, you want somebody else to take on that risk, because you aren't able to actually cover it, right? Like if something were to happen and you didn't have income anymore, but a spouse still needed to take care of the bills, you need to have protection against that. You need to be able to cover that. But for a lot of people don't realize that when it comes to the stay-at-home mom, the stay-at-home parent, especially, they think, oh, well, I'm not bringing any income into the scenario, so I don't need life insurance, right? And, that's just kind of the thought. They're like, oh, well, because my spouse is working, we need life insurance to protect that income, which is correct. But then, they go, but I'm not bringing in income, so I don't need any. But I mean, for any stay-at-home mom, I always like to use my wife as an example for this, because I'd be completely lost without her. I mean, it's very easy when you think through what a normal day looks like, even how much value mom is providing to the household. Well, from, whether it's cooking meals to doing laundry to cleaning the house to helping to raise kids. I mean, anyone can try to go out and price what it would cost to cover all those things if the mom wasn't in the picture. And I'm not trying, whatever the stay-at-home parent is, but for this, but if the mom wasn't in the picture, that's a big cost. And a lot of people say, well, our friends would do it, or we have family in town, or we have parents, or our church would step up. Okay, hopefully, yes. But for most people, I know, at least for me, I don't want to be a burden on people. I really don't. I don't want other people, to be a charity case for people or otherwise, because I made a bad decision. At the end of the day. So, I mean, it's going through, and if in anyone's different area, but you think about, okay, so if you had we're paying someone to come in, I guess, Amy, how many loads of laundry do you do a day?
Oh my gosh. At least a minimum of one, but realistically 2 should be done.
Yeah, absolutely. And some days I mean, especially this time of year, maybe 3 or 4.
Oh yeah, the
If you
dryer's on
have pets,
constantly running. If it snows, the
yeah,
dryer's on all the time. Snow clothes,
exactly.
dryer all day.
It gets a rest from about midnight to like 6 a.m. And that's
Yes.
about it,
Yeah. Yep.
So, you think about that, or if someone was to come in and clean the house, and it's not, oh, they're coming in once a week or once a month. I mean, Brad, have you had this happen where Amy went out of town and you were left at home with the kids for a few days?
Mm-hmm.
And was the house complete squalor and just a mess? I mean, for me, I know that's what happens. Like it comes back and the mice start moving in because there's like food on the floor and
I have anxiety when she comes home.
It's mad. It's
Yeah, 'cause
usually
she's
a
gonna
mad
see
dash
the house.
scramble. He's like, give me some time before you're headed home
Yeah.
so that I can do all of my cleaning. Like he just kind of leaves it to the end.
Give me heads up. Yeah. Or, when McDonald's, makes an extra few grand a month or a week because, you're not cooking dinner.
Yeah.
You're at work, you're doing work. I mean, all those things and are a value, and they're real value and they're tangible value. And it's not to speak of it as such of, well, just to put it in very cold terms, but you think about if something were to happen to that person, what would it take to be able to replace those? And then on another note is the whole okay, so for me personally, if something happened to my wife, I would probably need some time to deal with it, to mourn, to go through that. And if there's not a cushion there, if there's not a net, if you will, and it's like, well, no, you got to be at work on Monday because you still have to be able to put food on the table and help pay for those costs to provide for those things that, you can't do that if there's not a cushion or something there. So it might be a little bit, macabre, but people need to think about that and have that conversation because we all live with, a certain amount of hopium in our lives that we don't really think about. That's like, hey, of course we're going to live forever. Of course we're not going to get sick or diagnosed with cancer or hit by, the Pepsi truck, whatever it may be. But, the sad reality is it does happen, and Lord willing, it doesn't happen to us, but we don't know. So you gotta plan for it.
You had us do a really good exercise and you had us go home because when we met with you, you didn't just say, well, I suggest you have this much, or I suggest you have this much. You said, you need to go home and I want you to write down all of the things that Amy does. I mean, I was just like, I like him. He knows that I'm worth something because it was such a good exercise. And Brad already knew those things, but we'd never wrote them down, right? We'd never actually put a dollar amount on it and listed them out. So we wrote down, you had us go home and write down all the things that I do on a day-to-day basis and all the things that we would have to pay for if I weren't in the picture, if something were to happen. And like you said, like this is a very morbid conversation, but we're adults. We need to have these conversations, regardless of how uncomfortable it is. We need to face it and talk about it. So we went home, and one thing that you didn't mention that I want to bring up because it's a huge cost is daycare. You would have to hire somebody to watch the kids during the day because, and now we have 3 children. When we had first met with you, there was 2, and they weren't in school yet. So that would have been full-time daycare. And so, we listed it out. Like I do a lot of the gardening, so like hiring somebody to take care of the yard, doing the laundry, cleaning the house. And that's like you were saying, I mean, that comes down to like very granular things, like not even just like once a month cleaning the house. This is somebody, you'd almost have to have somebody come in and like help take care of the house on a day-to-day basis. And fixing things, hiring more people to fix things around the house because you're not going to have time to do it if you had 3 kids. So you had us go home and write down all of these little things. And we were very, very surprised by it. So I thought that was a great exercise that anybody can go do with their spouse, or even just stay-at-home moms can do for themselves, to realize. And I think there's even some research out there. There's if you Google it, I think they have some statistics and numbers, what a full-time mom is actually worth, even though you're not getting that income, but what they're worth. I don't know if I'm explaining that right, but what they're worth,
what their
Yeah.
value is.
what their
And there
value
is.
is. Yes.
Yeah, I always like having people do it for themselves,
Mhm.
because it brings it home. I mean, and if ever there's one of the spouse, or I'm gonna throw um, um, guys under the bus here, but if they ever think like, oh, well, I don't know, we can take care of that or anything, just try doing it for a day or two, and then, see, because I don't know. A lot of people are a lot more talented than I am. So,
Mhm.
but for me, I know, no, that I need somebody to
Yeah.
help. Yeah.
Yeah. So I'm going to run another perspective by you. I just had a conversation with a friend who I had permission to talk about this on the podcast with, but I just had a conversation with a friend, and their perspective is different than ours. And his perspective is he would rather take that monthly payment, which I explained to him is actually for us very inexpensive for the life insurance policy that we have. But he would rather take that and invest it and put it in mutual funds, because he says his mindset is, well, I can get that back someday. But when I put it into life insurance, I won't ever see that unless you need it, unless you end up
Sure.
having to have it. But he said, if I pass away, then it's not a lottery ticket for my family. My family doesn't win the lottery because I pass away, because our life insurance policy, I mean, I'll just be really honest, is Brad's life insurance policy is $1 million. And that was something that, and people are going to hear that and be like, holy shit, that seems like so much money. But when we broke it down with you, and I encourage anybody to actually talk to their financial advisor about why that number is what it is. And when we don't have to dive into that today necessarily, but that's ours for him. And I can't remember exactly what mine is. It's 500,000 or 750.
I think it's 500.
Yeah. Anyways, I don't know. I just really want to be transparent with people, because if they're like, well, what is a good number? Well, that's what we have, but we had a very honest conversation with you about it, and this is why it's that number. But so when you say that to people, they're like, holy cow. And so his perspective was, well, my family doesn't need to win the lottery just because I pass away. My wife will probably remarry. I'm not going to pay for all of my kids' college tuition with that. So what would be your response? And I'm not saying I want to just bring this conversation up because I think a lot of people feel that way. And I'm not saying that he's particularly wrong, because that's just the way his mind works. So I don't want to say it's negative, but I do want to hear why you feel there's a better way to think about that.
Sure. Absolutely. So a couple things, I guess. First off, with I'm going to try to take these in order as far as I think they bleed into each other. As far as he would rather take the money and invest it, because at some point it will make up that. And yes, at some point it would. But the reality of the matter is, and anybody can run a future value calculator to see, what is the amount. So, for example, you'd have to talk to your advisor, your person, to find out cost of things. But I'm going to just throw out a random number. But if someone was paying, let's say, $20 or $25 a month for their insurance, right? So in essence, what is that? They're paying $300 per year for their insurance. And if they have $500,000 of insurance, and once again, that's not a quote or anything else, so don't anybody take it that way. But if they're, and just, for illustrative purposes, if they're paying $300 a month for $500,000 of protection. Well, even after 30 years, they will put in 9,000, 300, 9, yeah, about 9,000. I think the math, it's late. Anyway, $9,000 total over that time period, over those, assuming it was level term insurance, over those 30 years for that $500,000 worth of protection. If anybody, if anybody can find me a reasonable investment that, they can put $9,000 into and it's going to turn into 500,000 even out, and it's not 9,000 all at once, it's 300 a year over that time period. I mean, I'd love to see it. I'd love to see that.
Sign me up.
I haven't seen it yet, other than, somebody winning the lottery, but those odds aren't very on your side. So,
right.
First off, I would say he probably hasn't thought that through enough for just the math side of things. But then for the whole idea of winning the lottery or otherwise, I know a lot of people who have had this exact same conversation with a whole lot of people. And the reality is, so you got to be a pretty cold-hearted person to do that. I'm not trying to speak ill of your friend or anything that way, but to come and say, oh, well, you know what? My wife's just going to remarry and find someone else and someone great to come take care of them and my kids and, take care of everything. And obviously that'll happen, really quick, right away. I'm sure she won't need any time to mourn or to search for someone good or to find someone. And it's super easy, especially for a married person with children, to go out and find another spouse. There's actually, I'm sure, a line of them waiting somewhere.
Right. Yeah.
No, that's not real life. It just
Right.
doesn't happen that way. And on the other hand, I mean, if something happened to me, yeah, I would hope my wife would find somebody and be able to move on and be happy. But I would also want her to have that choice. Like,
Right.
I'd like to think that it was good enough that she would have a little bit higher standard or bar of who she was looking for and wasn't just looking for the first Joe that came along who would hopefully take care of, her and my kids. It just, when you talk, it seems so silly because it kind of is. Like,
right.
Nobody's actually going to do that.
Right.
And as far as the whole winning the lottery thing, I've never talked to somebody who's said, I would much rather have the money than, my husband. I'm sure those people are out there. Once again, that's probably a marriage counseling situation, but it's, for most people, it's like, no, absolutely not. And the ideal situation is that person lives. I mean, obviously, for a family, it's a much better family situation, and you want to grow old together and all those things. But it's just about being responsible. I mean, I don't know anybody who goes out there and says, hey, you know what? I'm not going to get car insurance because, you know what? I'm never going to get in a wreck. And if I do get in a wreck, well, I don't want my family winning the lottery and being able to buy a brand new car. Then what? I mean, or I don't want health insurance because, it doesn't make sense. It is the whole point. And when people look at the amounts of insurance, I mean, I don't think people have a real, especially during their working careers and especially when they're young, especially of how far money goes and how far it doesn't go. You talk about $1 million and you say $1 million, oh my gosh. Well, with inflation now, it's going less and less each day. But even that, $1 million, it's not like, oh, okay, now they're going to be able to retire and go, sip on Mai Tais on the beach in Hawaii anymore. No, it's not going to get there. if someone had $30 billion, then okay, let's talk. That might be overdoing it. But for the most part, if someone is having or gets the right amount of insurance, it's about responsibility of being able to take care of, your responsibilities even when you're gone.
Mhm.
And, it's providing for your loved ones.
Mhm.
If we didn't care about that, then why would we do the laundry? Why would we clean up? Why would we cook dinner? Why would we go to work?
Right. Yeah.
It's
Some of
so.
it for us is paying for peace of mind. I mean, and really just like you said, doing the responsible thing, and then just peace of mind, knowing that if something were to happen, it's okay. We would be okay. The house that we love and live in is all going to be okay. Especially for me, if something were to happen to Brad, I don't have to rush back to work. I don't have to worry about losing our home. I don't have to worry about paying for groceries. I don't have to worry about relying on anybody. We can be self-sufficient for however long we need if we take care of it wisely and consult with our amazing financial advisor and what to do with it if it ever comes to that. But what are your thoughts on it, Brad, for your perspective on, the husband and the dad's perspective? Hey, mama friend, I just wanted to take a second and remind you about my Mama Mindset Reset Challenge. It's absolutely free. There's no cost for this challenge. It's something that I put my heart and soul into, a tool for you to reset your mindset, to start improving your life on your own terms, in your own way, under the constraints of this challenge. It's 3 phases. It is a challenge. It's supposed to be challenging. It's supposed to help you grow. So if you're curious about it, please hop onto my website, amycawthorn.com. It explains it in more detail. If you haven't listened to the podcast that does explain it in detail, my words explaining the what, why, and how of the challenge, hop on and listen to that. And then I also have a couple of other tidbits of information on my Instagram page as well. So when do you start the challenge? You start the challenge today. You start it now. There's no sign up. There's no cost. It's only you holding yourself accountable to change your life. That's what we're doing here. We're taking action. We're taking action over our life. So Mama Mindset Reset Challenge, #MMR Challenge. Let me know when you get started. Send me a DM. I'm so excited to bring this to you.
Well, I mean, it is peace of mind. And I usually think about it, if something happened to you or I, what are the next steps? Because what would you do in that situation? And not having to worry about finances. I mean, that in all reality, that is the last thing you would ever want to have to worry about. You don't want to be forced into any decisions because you don't have money to pay the mortgage. I mean,
Yeah.
I know that's always the biggest thing that I think about is you're going to need time. You're going to need time to heal. You're going to need time to figure out how to live. I mean, money shouldn't be something driving those decisions.
Right.
So
Right.
that's always a
Absolutely.
big one for me.
Yeah.
Yeah.
So can we dive into, and I kind of want to add in here too, when I was talking about what we have as far as our personal life insurance. Well, let's go into this conversation a little bit, because can you talk about the types of life insurance really quick, Andrew, just so and give maybe some, like a broad definition of the different types?
Yeah, absolutely. So okay, one thing people should be aware of is life insurance comes in all shapes and sizes and names, and there's all the time where companies are coming out with something new, or they name it something different because most of it's marketing, to be honest, in that case. But in reality, all life insurance falls into 2 categories. So the first type of life insurance is going to be term insurance, and the second type of life insurance is going to be permanent insurance. So with term insurance, it's what it is you're just paying solely for the insurance, the cost of the life insurance, and nothing else. And if it is a level term policy, it means that that policy is going to stay the same premium for whatever that time period is. So if it's a 20-year level term policy, the premiums are going to stay the same for 20 years. Now, after that time period, if you kept that policy, the premiums would go up by quite a bit because you're quite a bit older at that point. But for those, for the 20 years in that example, it's going to stay the same. There are some companies out there that will sell term policies that aren't level term, that they go up over time with somebody's age, and you just got to understand what you're looking at that point. But I mean, that's probably your most basic and simplest and easiest kind of life insurance is term insurance. Now, on the other side, on permanent, there are all sorts of different types of policies out there, and how they're structured is different across the board. But the basics of it is that there is the cost of insurance and there is a cash value. Now, the cost of insurance on permanent insurance is going to be higher than it is for term insurance. And it makes sense that it would be because, I mean, the name permanent kind of tells you the whole idea of it is this insurance is supposed to be there for the rest of your life. So when, I mean, they kind of get in the weeds here a little bit, but when an insurance company looks at the statistical probability that someone's going to die, well, if they're looking at a 20-year-old and they're saying, what's the statistical probability they're going to die between the ages of 20 and 40? Well, that's pretty low. Most people don't die during those ages. It happens. That's why, you need to have protection, but it's pretty low. But for a permanent policy, they're not looking between the ages of 20 and 40. They're looking between the ages of 20 and maybe 90, or whatever the mortality table sets for how long people are living right now. But so they're looking at that time period. And the reality is, yes, you're going to pass away at some point in time. And those policies are made to pay out when that happens. But because it's over such a longer time period, and because they're, made to pay out, for term insurance, not every policy pays out because a lot of people don't die during that time period. And that's a good thing. And the insurance is still important. But for a permanent policy, if it's kept in force, every one of them will pay out because it's forever. So anyways, the cost of insurance is higher because of that. And then the cash value portion, every permanent insurance policy does it differently. Basically, you're putting extra in every month that is invested in some way. So some policies you're investing in the general account of the insurance company. Some policies you're investing in the stock market. Some are providing a interest rate of return that is stated on the policy. Some there's index, there's all sorts of things as far as it goes. But that's, what a permanent policy is doing. So, what people will see, and anybody can go out and get a quote and, find this out, but they can ask their advisor or an insurance person about this, but get a term quote and get a permanent policy quote. And, if you look at the breakdown of the difference, you'll notice that one, the cost of insurance is going to be much higher on the permanent policy. And two, they're going to be paying extra, and that's going to go into this cash value account, which, it has those. So the permanent policy might cost 4, 5, 6 times. I mean, maybe even more. Go get a quote, but what a term policy covers. So is that kind of?
Yeah, no, I think it's really good because I think there's a lot of people that don't understand that there's different types of life insurance. We've just been talking like generically life insurance, we've just been throwing that around, but ours is a term life insurance policy. And we decided, what I wanted to say is our dollar amount that we have, what we've talked to you about and what we've decided on, and the type of insurance that we have is something that we have discussed together and discussed very specifically with you to determine what is best for us personally. So what's best for us personally, the amount that's best for us personally is completely individualized, which is why it's really important. I wanted to add this in here to actually speak to somebody, to sit down with somebody, get all of the numbers out on the table, talk about all of your personal values, future plans. I mean, we discussed all of it before we decided upon the policy and the dollar amount that we decided on.
Well, and for example, I mean, when you guys went through and did your budget, right? And you came to a number of this is how much that we need to live at the level that the quality of life that we're living at, that's how much we need every month. Well, somebody else, their number is going to be different than yours. The amount they need is going to be different than yours. Their situation's different than yours. So, it's obvious that the protection that they would need would be different from yours. And one other thing I want to add, just because this is a little bit of a tricky thing that I hear that a lot of people don't understand. A lot of times in the industry, people talk about return of premium policies and they go, oh, that sounds really good. I'll, pay in for the life insurance and after 20 years, I will get back everything I put in. Well, return of premium policies at the end of the day are just a variant off permanent policies. But all the insurance company, what they're doing is they're saying, okay, here's the cost of insurance, and then you're going to pay extra on top of that cost of insurance that the insurance company is going to invest so that after whatever the time period they give you is, they'll be able to give you back what you've put in because they were able to make enough off that investment plus some that they're able to do that. So
and for
FYI.
And for some people that might be a great fit, which is why they have options like that.
Maybe.
For us, that's not an option based on our budget and what we can do. So I think it's really important to talk about. I think it's great that you talked about all those options because then people know kind of going into it. I think it's really good to do your research and do your homework. We knew a lot of that stuff prior to our conversation with you. So then when you were talking about these different types of insurance and different types of policies and things like that, we weren't totally in the dark. We weren't 100% naive, and we could ask specific questions and we understood how it applied directly to our personal situation. So I think that's what I wanted to kind of address in this too, is that do your research, do your homework, take some notes, and figure out some questions that you want to ask prior to going in and having a conversation with somebody about it.
Yeah, absolutely. And I mean, talking to someone who is willing to explain it to you and actually go through your situation is also super helpful because there's all sorts out there. Just having someone who actually is helping you understand it is going to make sure you end up with the right thing. So
yeah. Okay, so I want to run a scenario by you and ask you a couple of questions. And I know you had a question for Andrew too that I want you to ask in a minute, but I don't remember if in the beginning when we started recording, I told you about this scenario, but we recently had a close friend pass away, and his wife had recently stepped away from her career to raise their daughter they have together, and she's 6 months old. So it's very sad. It's very hard. So in the midst of finding out this news, we were driving back from Seattle. It was a very quiet drive home, actually. But one of the things one of the very first, I don't want to say first things that came up when we found out the news, but one of the things that I was thinking about, because I mentioned this in previous podcasts, that I'm kind of a planner. I try and we both try and be a little bit of a step ahead and think ahead. But one of my thoughts for this woman was, I wonder if her husband, our friend, had life insurance. And then we started talking about it, and we were just thinking, oh my gosh, I really hope that he had life insurance, because she is a full-time mom and she stepped away from her career and she loves it. She's so good at that role. She absolutely loves taking care of their daughter. And then as we were kind of having that conversation, we thought, well, if he had life insurance, how long does it actually take to get that payout? So
Sure.
from there, our conversation kind of went into, is this, in terms of us, we hadn't ever really had that conversation, okay, well, we have this life insurance and everything will be fine. Well, it was like, okay, well, wait a second. What if that took 6 months? What if that took 12 months? Would we be okay? Dave Ramsey says, you need to have, what is it? 3 to 6 months of, saving set aside. And so we're like, would we be okay? So what are your thoughts on that, Andrew?
Okay, so I can only speak for the company that I work with, and but I think it's pretty generally the same in the industry. Especially if you're working with a highly rated company, it's going to be this way. But when you get life insurance, one of the things you do, and one of the things you need to check in it, it's not a check it or a set it and forget it. You need to check it every probably at least 4 to 5 years, or every time there's a major life change, is who you've named as your beneficiary and who the primary is, who the secondary is, and so on and so forth. Because in the event that you do die, that's who it's going to pay to. So, for example, in your friend's case, let's say he did have life insurance, and let's say he only named his wife as primary, but he didn't name a secondary. Okay, well, now if in the example or scenario you laid out, it would pay out to his wife. Each life insurance company is different, but it's generally within 2 to 4 weeks is when the money will reach him. Can be faster, but usually the time it takes for the death to be reported, and then the person to indicate, they want the money sent to them by check or direct deposit, and to get a death certificate, it's usually 2 to 4 weeks. So that the money comes in. However, but let's say that the wife had passed away too, and then where does the money go? Well, if it's not stated, then it's going to be part of their estate, and it's going to go into probate with the rest of it. If they have a 6-month at home, I hope they have a will, and I hope they have outlined who the guardians of the guardian of that child is going to be, and so that would get paid out. But probate can take anywhere up to 6 months. So if someone, let's say, had, and people do this all the time, they will name their estate as the beneficiary. They say, we did a will, and the will dictates how we want everything taken care of. So it'll just get paid into the will. Or, well, not the will, but their estate, which the will tell, what we want done with it. Well, okay, now it, like everything else, has to go through probate, and that's process could take up to 6 months. Okay. So, it's one of those things. It's really easy to take care of, but a lot of times people don't remember to check it and update it when it needs to be updated. Who's the beneficiary? But assuming that the beneficiary is, been listed correctly and that's taken care of, then generally 2 to 4 weeks.
And when you say life events, you're talking birth of another child. What else would you qualify as a life event that would need you to kind of reevaluate that?
Anytime something major happens in your life, you should reevaluate those things you have in place. Your health insurance, that's all covered. Your life insurance, that's done. I mean, things like birth of another child, change in your status. If maybe kids are leaving the home, if there's a divorce or death or anything that way, there's changes that are going to need to be made. So, it's kind of one of those rules of thumb that every 5 years, if you haven't done it more often than that. Every 5 years, you should take a look at your will. You need to take a look at the beneficiaries on all your accounts, retirement, life insurance, in bank account, whatever. You just need to check and make sure everything is up to date.
I love that. Okay. So thank you for answering that question. That was something that we didn't even know. So that was a personal question for us too, as we were going through this scenario, which is it was really, I mean, it's still really hard to even fathom, that scenario and the fact that he has passed away and she's here now with their 6-month-old. But it was a big eye opener for us. This can happen to anybody at any time. And it was just
Can I add one thing actually to that? Because I've actually had to go through this twice in the past year, unfortunately. But the one caveat to that is also if it's a contested death. So, so for example, I had a client who got life insurance and then actually shortly after getting life insurance got diagnosed with brain cancer and ended up passing away a year later. Well, there's rules in life insurance and that if somebody die, that it's basically contestable for the first 2 years. So they're going to go back and check that they didn't lie about anything or that it wasn't suicide for the first 2 years. It's contestable on those for that. But if it is within the first 2 years, then they are going to go back and check. And so they'll order like medical records and otherwise, and that can draw the process out to be more like 8 or 9 weeks instead of 2 to 4. So
and even then that is still relatively fast. I mean, that's relatively quick. That is quicker than what I was thinking. What do you think? If you
have your emergency fund in place, it shouldn't be a concern.
Yeah. Okay. What do you think?
Yeah. I mean, if it's that quick, that's great. I mean, that's not bad.
Yeah.
If it was 6 months or longer, that would be an issue.
Right. And that's in the back of my mind. I was like, well, what if it's 6 months, and you have to deal with phone calls or emails. I mean, I was just thinking about the logistics, worst case scenario. I guess maybe that's the that's the I don't know, planner in me that thinks
planner in you.
Like worst case scenario. So do you want to ask Andrew your question? Because I think it's a great question.
Yeah. So I'm always really curious, and I think I know the answer, but I'm not sure. So I'll let you explain it to me. So what would your advice be? So say, for example, someone passes away, they have term life insurance, and let's just say it's $500,000. How would you advise a spouse to utilize that money?
Yeah.
I'm really curious if you would say take it in a lump sum or take that and turn around and invest it and take it as income off of interest. I don't know how.
One of the scenarios, I'll add to that an example. One of the scenarios we added is, do you pay your whole house off and then live with whatever's left? So there's like another piece to add in there.
Yeah. So I'm curious. I know every situation's different. There's a lot of unknowns in that, but I'd like to know what you think.
Yeah, absolutely. So, and this should be part of the conversation when people are doing their research and finding out what's the right amount of life insurance. Like this really plays into that. So my general is when I'm going to use the spouse who's working for the example in this, but it correlates over in the same way to the spouse who's not working. It's just a little bit more legwork to figure out the amount. But what I'm looking at is I want that person to be able to take that money and invest it so that the return on that investment is enough to replace their income.
Hmm.
Okay. So that the surviving spouse, let's say it's a stay-at-home mom, doesn't have to ever worry about going back, to work anytime soon, right? That they know that income that was coming in, they can still count on coming in. Because, and somebody's like, well, wait, never go back to work again. Well, maybe go back to work again, but if somebody's done their planning, right, and they're going through, they're thinking, okay, if we're making X amount of dollars, we're not just talking about paying the bills every, putting food on the table. That is, maybe need numero uno, but that's not the only thing. If people hopefully are able to be putting away for the future and paying themselves so that one day they can be financially independent, so that when they're no longer able to work or maybe don't want to work anymore, they don't have to. Okay. So if something happens to somebody, those are things that should be considered too. And that right now they should be hopefully accounting for out in their income. Well, just because the person dies doesn't mean those needs go away, right? So at that point, it becomes a pretty easy equation. And all you have to do is figure out what rate of return you expect and a person to be able to get on the investments. And I will warn that people should be more conservative than aggressive when they're thinking about that number. Because if you go and say, well, I can make 10, 11, 12, 15% rate of return in the market. Yeah, there's bad years, but it always comes back. Well, if you're living off that money year to year, then those bad years might actually sink you because of the order of returns. And I'm not going to go down that rabbit hole too far, but anyways, that's just a part of it. So what you basically do is you say, okay, what rate of return am I expecting? If it is a 10% rate of return, for example, and you're using the working spouse's income for that number. So if they make $100,000 a year and you expect to be able to make 10%, then you just say 100,000 times 10 equals $1 million, because 10% of $1 million is 100,000.
Mm-hmm.
So if you're trying to replace that $100,000 income and you're assuming a 10% rate of return, that's $1 million. I mean, simple as that. If you're assuming a 5% rate of return and the person was saying, okay, I need to replace $100,000 a year at a 5% rate of return, well, then you would need $2 million, because 5% of 2 million is, once again, $100,000. Mm-hmm. So it's a pretty easy calculation at that point for the working spouse. For the stay-at-home mom, it's a little bit harder, just because you have to figure out, go through and do the legwork, like Amy was talking earlier about the value of all those things that are provided. So daycare, cleaning, all those things, you got to put a value to that. And then, but once you have that value, you can basically do the same thing. Mm-hmm. And then some spouses will say, well, okay, yes, but I only need that. My kids are 5 and 3. And so I don't need that for the next 30 years, because at some point they're going to move out. They are not going to be there anymore. Mm-hmm. And I won't need that anymore. So maybe they only need a 15-year term, and maybe they only need a smaller amount, because they're not looking to create that in perpetuity or ongoing. They're just trying to cover it for that time period, at which point you could say, well, to pay for that, I need $50,000 a year, and I need it for the next 10 years to get my kids to a point where I don't need those things anymore. Well, then you could say, if I expect no rate of return, I could do it for a $500,000 policy, because 500,000 divided by 10 years, $50,000 a year, right? Or, do the math to, if you want to figure a rate of return in there to account for it. But yeah, does that Make sense?
Yep, that makes sense to me. Yeah.
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 And
so,
I mean,
oh,
sorry, one
I'm
thing,
sorry,
I was
Andrew.
just going to,
Go ahead.
yeah, I was just going to say one other thing. It's why it's a good thing to have a plan, whether you have an advisor, whether you're competent doing it yourself, but and both the husband and wife should know talk about these things, but where would they go and do that investment, right? Like if the husband is like, well, I'm really comfortable and I know about markets, I'm really comfortable investing. And the wife's like, well, I don't know anything about it. Well, then the husband needs to educate the wife, or they need to have somebody or that they're comfortable and trust that they go to for that. Because the last thing you want is to have it set up and then the surviving spouse be like, well, I don't know what to do, so I'm going to just stick it in the bank, and now it gets drawn down until it runs out. I mean, still a good thing, but it really did accomplish everything that it could have.
Yeah, and I want to go back to the part of Brad's question that I added to with the house, because that was a specific scenario that we asked you about. Because in our mind, when I remember this very vividly, we were like, oh, well, we'll pay off the house first and then. And you actually had suggested, as we're talking about, your ROI, your rate of return, is not paying off the house because that lowers your rate.
Yeah. So, I mean, for most people, and this is obviously unique to each person and when they bought a house and their credit rating and all that. But for most people out there right now, sorry, my phone keeps trying to ring on me. I should have silenced that before. For most people, at least right now, interest rates are floating right around 3%. Okay. So if someone goes out and says, okay, let's say take Brad, for example. Brad had, you said you had $1 million worth of life insurance. And so I'm not revealing anything that you haven't said.
Yeah.
So you have $1 million worth of life insurance, and let's say you owe $250,000 on your house. Okay. So if you passed away and Amy went and paid off the house with that $250,000, well, basically what you've done is you've said, okay, I've relegated that 250,000 to a 3% rate of return, because that's, what you were saving yourself by doing that. So if you were planning on, inside of the planning, if you said, we'd expect that we'd be able to make a 10% rate of return, and then you go off and pay off the house, well, immediately you're behind. You're lagging behind and falling behind that. So yeah, if that you'd said, for example, oh well, we're planning on a 3% rate of return, well then it wouldn't make any difference. You could pay off the house or not pay off the house, wouldn't make any difference. I will say at today's interest rates and the current inflation rate, though, it's well, to each their own. Just numbers wise, it doesn't make a lot of sense, but to each their own.
Right. So. But I think that it is important for you to talk again, if you choose to go with a financial advisor to get in life insurance. I think it's important to talk about those scenarios. Would you rather, if something were to happen, and it might be different for each spouse. So for example, if something were to happen to Brad, would we feel better paying off the house? And if we would, then you need to take that into consideration when you determine your number. And if, if Brad feels comfortable, like if I were to die or pass away, would he be okay paying the mortgage payment? So then, in not paying off the house right away, there's just so many scenarios that you need to discuss and see. Because some people would just be like, you know what? I want the peace of mind. I want to know that my house is paid for, done, boom. I don't ever have to worry about it no matter what. Well, if that's a priority to you, then you just need to consider that when you're talking to somebody in when you're determining your numbers.
Absolutely.
Yeah.
Yeah. I mean, that couldn't have said it better. That's what you got to look at and say, okay, is it a priority? And I like to use the sleep test, which is, are you going to lose sleep over it? Right? If because there are things that it might not be the exact best financial decision, but sometimes, emotions often override that. And, it's not worth losing sleep over. So,
Right.
and people got to look at that and answer that question for themselves.
Right. One thing I will say, that one of the things that we do love about working with you, Andrew, and your, I guess, relationship with the Dave Ramsey program and everything like that is, and this is just something that I want to encourage people. I know a lot of my listeners actually follow Dave Ramsey, and I think that's great. I'm like a Dave Ramsey proponent. If people don't, to each their own. But for those that do, finding a financial advisor like yourself is so empowering for us, because we went into it having other financial advisors and kind of already kind of thinking about what we were going to hear from you and what our priorities should be, which really doesn't line up. And I'm not trying to speak negatively about them at all, but their priorities were different than our Dave Ramsey, learned priorities. And when we were talking to you about that, you were like, yes, this is, you were Dave Ramsey lingo, ready to go. And you knew where we were at with our plan. You knew we were at that point still working on our snowball. And then we were working on, at that point, the next priority was our 3 to 6 months. And so when we were talking to you, what was that?
Emergency fund. Sorry.
Yeah, our
maybe
emergency
step 3.
fund.
Yeah.
Yeah. So it was very comforting for us knowing that you were on the same page with what we were doing, and you were very supportive in what we were doing, because other financial advisors, that we had in the past weren't as supportive of our plan. So I guess my encouragement is, if you are on the Dave Ramsey plan, if you are working on that, to find a financial advisor like you, the Smart Vestor Pro, I can never remember the name of that, that is on the same page as you are as investors. So I thank you for that.
Yeah, I appreciate that. And I would say anyone really, if you're going to be working with somebody, find someone who is going to come alongside you, is going to guide you, and is going to understand where you're at, and then help to educate you and build you up. I always used to use a phrase like, don't ever give your money to somebody who just says, give me your money, and pats you on the head and says everything will be okay. That's how people lose a lot of money. It's, you want with a financial advisor, you should be building a relationship with that person that is going to last a long time, and you want to know that they're in your corner, and think similarly to you. And they might challenge you on things and give you advice that are good recommendations, and to move forward, but they should have similar values to you, I guess, is probably a good way to put it.
Yeah.
So.
Yeah. Did you have any other questions for Andrew?
Nope.
Okay. I just wanted to make sure I didn't exclude you. Andrew, thank you so much for today. I really appreciated this conversation. I do want to give you an opportunity. I know we talked about a lot, but I just want to make sure we didn't leave anything out. Is there anything that you want to add, or any piece of advice that we didn't cover today?
No, I don't think there was anything left out. I would say, and just encourage people to have the conversation and think about it. And, there's the right time to take care of these things, but it's, in a lot of ways, it's never too early to have the conversation about it. And usually, I don't know how many times I've run into people in their 20s who it's like, nothing's ever going to happen to me. And then I see them 2 years later, 3 years later, and all of a sudden they've been diagnosed with diabetes, or, whatever it may be. And now all of a sudden, oh, you're not insurable anymore. Sorry. I mean, you should.
Yeah.
Not much you can do about that. And, life happens to everybody, but it's worth thinking about and having the conversation. And, so that even if it's not now, you're ready, you've thought about it,
Mhm.
and you know when it does need to be. So
Yeah. I love that. So I will put all of your contact information in the show notes below. We talked earlier, you are certified in a number of states, but you are not certified in others. But you are open to having a conversation with anybody. If they have any questions, they can talk to you. So I just wanted to put that out there too, that if you want to talk to Andrew, you're more than welcome to reach out to him. I'll put all of his information in the show notes below. So you can. So Andrew,
Yeah.
thank you so much for today. I really appreciated you coming on and answering our questions and explaining it and taking time.
Absolutely. And thank you so much for having me, Brad and Amy. Yeah, happy to help.
Yes.
So.
And thank you, Brad, for coming on too, having the dad perspective and the husband's perspective. So Andrew, thank you so much again, and we'll talk to you soon. Okay.
All right. Sounds good.
Hey, sweet mama, thank you so much for listening to today's conversational journey with Andrew. Brad and I had such a great time talking to him, obviously, because we know him. He has been our advisor for a number of years now, and we always really appreciate his advice, and we always feel accepted and empowered, and we always learn something from our conversations with him. So I hope you learned something today. I hope this maybe shifted your perspective on something today, or gave you some tips, tools, resources. We talked about a lot of stuff. We talked about how to find a Dave Ramsey certified financial advisor. They call it the SmartVestor Pro. I'll put all of that information, including Andrew's contact information, in the show notes. So what I encourage you to do is to take some action steps. Don't wait until it's too late to take some action steps. Take some action steps today, right now, right after you listen to this podcast. And that first action step that you can take is communicating with your spouse, communicate with your partner and your husband, and see, where are we? Are we in a good place if something were to happen to us? And I know that this is a tough conversation to have. It makes you feel really uncomfortable because it's a morbid conversation. We don't want to think that something is going to happen to us and we're going to leave our children. But I encourage you, within this group, within this community, we want to plan ahead. We want to be prepared. And this is one of the ways that you can be prepared. So if you found value in today's conversation, please share this to your social media pages, share this with another friend, have this conversation with another friend. And if they have any questions, send them the podcast link. I encourage you to have this conversation with other people and gain other perspectives, but mostly your partner, your spouse, as well as your financial advisor. Please go out there. Please take action steps today. And don't forget to share the podcast episode. So thank you so much for joining me today. I look forward to talking to you all again very soon.